Hi, I'm Christian Phillips. I'm the principal broker and owner of Inlet Realty and Property Management out of Virginia Beach, Virginia. And today I'm here to talk about investing in commercial real estate. Investing in commercial real estate can create returns significantly higher than in residential real estate, but it's a different game and it can be intimidating if you're not familiar with the language that these folks speak. Commercial real estate is not as difficult as people would like you to think that it is. Commercial real estate guys love to use lingo to make you think that they're smarter than you or that they're the only ones who are smart enough to do this, and that's simply not the case. Most of these things you've already heard of and you're already familiar with. It's just different nomenclature in the commercial real estate world. Things like cap rate, T12, rent roll, all of those things you've heard of before, you've seen before, just under different names. Let's talk about cap rate. A cap rate, which is short for capitalization rate, is your return on investment expressed in an annual percentage based on the purchase price of the property. So if you had a property that you paid $1 million for, and at the end of the day, after all of your expenses, your net profit was $60,000, that would be a 6% return on your investment annually. And so we would call that property a 6 cap. Cap rate does not include any sort of calculation based on your financing that you may have used to purchase the property. It's only based on the performance of the property itself. It is straight annual return on investment. The cap rate is almost always related to the amount of risk to the investor. The lower the risk, the lower the reward, and vice versa. The risk in purchasing commercial real estate can come from a number of different places, whether it be the location, the condition of the property, or just the overall quality of the property that you're purchasing. In our market here in Southeast Virginia, extremely low risk multifamily property that's in good locations with good condition sells usually with about a 5% return on investment, or you would say that they sell as a 5 cap. Higher risk properties that are in high crime locations or in poor physical conditions can sell for a 10 cap or higher. When you're buying a property, you want to negotiate a deal that gets the highest cap rate possible. Conversely, when you're selling a property, you want to get the lowest cap rate possible, which will drive the sale price up. Some investors' entire business model is based on purchasing properties that are distressed at a high cap rate, improving and stabilizing the property, and then selling the property at a much lower cap rate with a significantly higher sale price. If you're looking to calculate your real return on investment when you're using financing, you need to calculate what they call a cash-on-cash return. With a cash-on-cash return, instead of looking at the pure performance of the property, it looks at the true return on investment based on the amount of cash that was laid out to purchase the property. You can have a well-performing property that does not provide a good cash-on-cash return because the financing doesn't make sense. As interest rates go up, market cap rates go up because most investors use financing. As the borrowed money becomes more expensive, the cash-on-cash return suffers, and cash-on-cash is really what's most important to most investors. You wouldn't want to put $300,000 down on an apartment building just to break even every month. That's no cash-on-cash return. Okay, next term, retrade. This is just another term for renegotiating the terms of your deal in the middle of the deal after the ratification of the contract. This usually happens near the expiration of the study period of the contract. You as the buyer go in and find that the property is not in as good of shape as you thought it was. So in exchange for removing your contingency, you renegotiate the purchase price or you renegotiate some repairs to the property. That's a retrade. Okay, next, rent roll. This is a report that shows a directory of all of the tenants that live in a property, what they pay in rent, and when their leases expire. This is an incredibly important tool when analyzing the current income and potential income of a property, whether it be multifamily, office, or retail. Okay, next, T12. You'll hear people say, "Can I see the T12?" This is just a report. It's a cash flow report that shows the trailing 12 months of income and expenses on a property. The T is for trailing, the 12 is for 12 months. You may have people provide you a T6 or a T3. This is just a cash flow report again, showing the income and expenses for that number of months. Okay, last term, OM. OM is short for offering memorandum. This is a big, fancy, highly produced PDF file that is the official sales pitch for a commercial property. This document, which is usually produced by the listing agent of the property, shows color photos of the property, information about the area and the local economy, local demographics, and a full financial analysis of the property. OMs will also contain comps or records of comparable properties that have rented or sold in an effort to justify the asking price of the property. If you are looking at purchasing a commercial property, it's important to remember who this information was prepared by and that you really shouldn't trust any of it. This will give you a good idea of where to start, but verify your own information every time. This is a sales pitch that was designed by someone who does not work for you. They work for the seller of the property. So always do your own due diligence. Hiring an experienced buyer's agent that you can trust will pay big dividends at this point because it will keep you from making mistakes while you're new in this industry. Okay, that should be enough to make you not sound like a beginner. Don't let their lingo make you think you can't do this. The financial barrier to entry in commercial real estate is another thing, and it's higher for a couple of reasons. First off, prices are higher in general. So whatever percentage you have to put down on your loan is a percentage of a higher number, meaning more cash out of pocket. Second, the down payment percentages themselves are often higher on commercial real estate. So instead of 20% down, you're almost always looking at 25 or 30% down, and that's of a larger number, remember. So again, more cash required. But wait, there's more. Even though most commercial loans are amortized over 25 years, most of them also have a balloon payment that's associated with them, calling the full balance of the loan due somewhere between 5 and 10 years after you purchase the property. This means by whatever that time limit is, you either have to pay off the loan, refinance it, or sell the property, which also pays off the loan. Unlike with residential real estate, most banks don't want to be on the hook for the loan for the entire duration in commercial real estate. And if that wasn't enough, most banks will be all up in your business for the full duration of the loan. Most commercial mortgages require annual reporting on the performance of the property. And if the property is not performing in the way that the bank thought it would, they can call your note due, in which case you have to refinance the property, pay off the mortgage, or sell the property. Lastly, some banks are hesitant to lend commercial money to inexperienced investors who do not have a significant net worth yet. This is where partnering with another investor can open doors for you that may not be open otherwise. There are some creative ways to raise the down payment money that is required here, such as partnerships, joint ventures, and establishing capital groups. You don't have to go at this by yourself. Capital groups crowdsource the down payment and then make the purchase in the name of the company. The company then pays agreed upon returns in an agreed upon time frame to the investors who put up the initial money. Usually this happens in a few years when the property is either sold or refinanced. That's how capital groups are really cleaning up in this game. They crowdsource the down payment, they make the purchase, then they add value to the property. Then, between the value that they add, the actual appreciation of the property over time and the amount that the loan is paid down, the capital group can usually refinance under terms that pay off all of their original investors on the agreed upon terms, and the capital group gets to keep the property. These capital groups may need to be registered with the SEC depending on how they are structured and how they are raising that initial money. If you are going to attempt to start a capital group on your own, please contact a qualified attorney to give you the guidance that you need to make sure you stay on the right side of the law. Now, if you want to just dip your toe in the water, you can invest in commercial real estate by giving your money to a capital group, but you'll be exchanging less risk for less reward. At the end of the day, the capital group will be using your money to build themselves generational wealth. Okay, so that's a lot, right? Well, it's worth it. So once you own the property, you have to maintain it, right? And hopefully you'll be able to add value to it. The last thing you need is for your loan to be called due because of a lack of property maintenance or poor management. I do know a handful of investors who manage large strip retail investments from a remote location with relative ease. This is due to the fact that in most of these cases, the commercial tenants are the ones who are responsible for the maintenance on the buildings. The owners only handle leasing. If your property, for whatever reason, has a lot of turnover, it would still make sense to hire a property manager to handle that leasing for you. Be prepared though, when you do, the fee structure on listing office and retail commercial property is significantly different than residential multifamily or just straight residential. Most of the time, the leasing fees that you will owe will be based on a percentage of the entire rent of the lease. These fees on a 10, 15, or 20-year commercial lease can easily reach 6 figures, and you need to be prepared to cover that out of pocket at the time of the lease. With multifamily commercial property, rarely does it make sense to try and manage these yourself. I have seen some investors live in one of the apartments in a building and manage the rest of the building, or manage a smaller property themselves if they live locally. If that's a possibility for you, that is a way to save a ton of money, but you don't have an investment anymore, you have a job, and it doesn't scale very well. Overall, commercial real estate investing is a great way to build generational wealth. It is not risk-free, but no investment is risk-free. In our next video, I will have a real commercial multifamily opportunity for you all to consider. A 6-cap property in Chesapeake, Virginia with 48 units. Even if you aren't in the market right now, this will be a great opportunity for you to learn what needs to happen for you to properly underwrite a commercial multifamily property. Thank you so much for watching. Until next time.